So a couple of smart, Keith. First, you kind of just hit on this, but can we draw down, and I assume they mean the broader equity market, with consensus flipping to bearish on every dip, or is consensus already behind due to the missing the rollover in social media consumption stocks and accelerating inflation?
Well, the broader market, I think most would characterize as the Russell 2000. You know, the monkey would say the Dow, right? I think Kernan, not to name names, wakes up every day and says, well, we're up 100 points. We're down 100 points. I mean, seriously, that's how much we've evolved in this profession. I mean, nobody looks at the Dow as the broader market index. The broader market index is the Russell 2000. It's down 9.2% since March, and yesterday got absolutely tattooed. So I think that consensus is now giving up on the bounce. So first of all, to define consensus. Consensus was long growth at the beginning of the year. They were bearish on bonds. Then they got hammered. Then they doubled down. Now the double down is losing money too. The only mistake you can make after making the first two mistakes is to triple down. Now to triple down, you better have a catalyst. And if Bernanke's your catalyst, that dinner, that's not a good catalyst. Because the Fed's going to start to get negative on growth because growth just isn't there. Again, retail sales constitute 24% of GDP, and that number last week was a certified disaster in as much as all the housing data is.
Yep, and then kind of along those same lines, does the fact that returns in the equity long-short space are so bad this year help insulate something like the SPY? And won't investors start to feel pressure to chase large caps, which have performed modestly well year to date, effectively buoying something like the S&P 500?
Yeah, I think that's a great point. Whoever asked that question, it's a very astute observation. Now we're seeing, I think, average hedge fund performance is like up 1 or so for the year. And what I'll hear a lot is, well, you know, we can't do what you do. We can't move around that fast. I mean, to be clear, that's not my problem. I mean, the whole concept of hedge funds having performance problems once they get to a certain size and having, it's called liquidity as a factor that they have to navigate, forces them to actually look at this big cap reality after the move. So if you're staring at big caps in telecom, big caps in utilities, big caps in energy stocks, now you're kind of like, well, I wasn't positioned for this, but I got to rotate. And I think that that's a really risky spot. That's why I think that it's interesting to see utilities break down all of a sudden at the same time that all the stuff that's been lagging year to date confirm the breakdown. So when you can't buy anything, you're in a really tough spot. That's why I just say get over it and start shorting some stuff for real. Like if you want to really prove that you're better than the other hedge funds, strap it on and short some stocks.
Indeed, and just one more before we wrap it up. Big game last night in Connecticut youth hockey. Who took the W between Westport and mighty Darien?
Well, this is America in 2014, so we're not allowed to keep scoring. Everyone got a trophy, but we did do quite well.
Good to hear. All right, we'll wrap it up there, folks. Thanks for joining us this morning. Catch you back here tomorrow, same time. Have a great day out there.